Hi guys. So as soon as I posted my video on how I enter stocks, a lot of you started asking if I plan to make a video about how I exit my stocks. And you said that you wanted to know about how I manage trades, how I take profits, how I move my stops up to break even, etc. So this is going to be a video about my sell rules. And I think the sell rules are even more important than the entry rules because everyone's going to have the same entry pretty much. We all look at the same charts and enter when it's breaking out, and it's not rocket science. Most of our kids can do it as well. What really differentiates a good, consistently profitable trader from one who's consistently losing money is their sell rules. And in this video, I'm going to talk about all the different aspects of the sell rules that I have developed for myself over the years. And these have kept me profitable and my drawdowns as low as possible. So this video is going to talk about 4 things in particular. I'm going to start with how I plan my exits at the time of my entry. And this is really important to do. A lot of people I see don't do that. They'll just blindly enter into a breakout and then think about the exit later, which is not something you should do if you want to become a pro trader. The second is I'm going to discuss when to move the stop loss up to break even. This is another common question that I get asked a lot, and there seems to be a lot of confusion on this. And if you do this right, then this will keep your drawdowns really low. The third is I'm going to discuss my rules for booking profits. And lastly, I'll go through my rules for booking a loss. And I know no one likes to talk about or think about when to book a loss, but that's actually more important than rules for when to book a profit. So this video is going to be divided into 4 parts, and I hope by the end of it, you have a really good sense of what your exit strategy should be and everything that you need to know about when to sell. Okay, so I'm going to talk about how to plan your exit at the time of entry. And some of you seem to realize the importance of this. H. Pandit asked, how do you plan your profit taking and trade management before entering a trade? And this is something I always post on my tweets as well. Whenever I take a new entry, I'll usually post where I'm going to exit or how I'm going to trade it. I'll show you examples of that as well. Another example is these sorts of questions that I get asked quite frequently, which is, my issue is if I hold stocks, then they retrace from 5 to 10% and go back to break even or worse. But if I don't hold stocks, then they go up 20 or 40%. So I never know, what should I plan, think, or train myself to do? Basically, a lot of you have been asking, how do I determine the magnitude of my trades? And how do I plan this at the time of entry? So in this video, I hope to make that very clear, very logical, and show you examples of how I do it. So at the time when I am entering a trade, I ask myself a simple question. Is this going to be a position trade or is it going to be a swing trade? What is the criteria for a position trade? It's these 3. Either the stock has a major EP, and I'll go through a few examples, or the stock is a recent IPO that's breaking out of an IPO base. I'll show you an example of what that looks like as well. Or we're at the start of a new bull market. So, and I'll go through examples of those as well as discuss if we're in one right now. So these are the only 3 cases in which I'm going to treat a trade as a position trade. Now, in all other conditions, I'm going to take a trade and treat it as a swing trade. And I'll discuss what exactly the rules for selling a position trade and a swing trade are. Just hold on. I'm going to first go through the criteria for how to determine which is what. So in all other conditions, every trade I take is a swing trade, plus in every biotech's case, it is a swing trade. Plus, if you need to build portfolio traction, if your account, which means your account is not doing well, you haven't got a lot of profits this year, or we're in a bear market or a choppy market or a late stage bull market, and these are times when it'll be very difficult to build portfolio traction. Those are other times when I will be swing trading. Or if there's an upcoming news event, either about that particular stock or for the market in general, like say an FOMC or an election. I'll go through examples of those as well. Just keep these in mind for now. I'm going to go through examples of each point. So hopefully it'll be very clear by the end of the video. But this is something that I have written down and printed out and put up on my desk. So I always know at the time of entry whether I should treat the trade as a position trade or as a swing trade. Just a side note, in case you're a complete newbie and wondering what position trading and swing trading even are, then a very simple definition is position trades are much longer term trades that you hold for a few weeks to months, and swing trades are trades that you hold for 3 to 5 days at most. So just keep that in mind, but I'm going to go through the exact sell rules for each in a later section. Okay, so first let me take you through examples of each of these 6 conditions so you know what they mean. The first is if a stock has a major EP, or that means episodic pivot, then you're going to treat it as a position trade. Now, episodic pivot is a term that was coined by Pradeep Bonde over at StockB, and I got to learn of it through Kulamagi, who was one of his students that went on to make 100 million. And this is one of his favorite setups as well. This is a super powerful setup, which basically means that a stock has a really strong catalyst or news or earnings that come out, which completely change the growth trajectory of that stock. So Peloton, for example, in May of 2020, released earnings on this day, and I can show you what the news looked like and what the earnings were. So on this day in the pre-market, we had news, a lot of positive news about Peloton, and everyone talking about how the sales have gone up 66%, etc., because everyone was staying at home and buying Peloton bikes. And if I were to buy a stock on this day, because I find this news really positive, I would treat this as a position trade and hold it for a much longer time. So this is something for which you don't have a formula, but this is very subjective, and you have to use your common sense about whether a particular catalyst or news is a game changer for a company or not. And if it is, then treat it as a position trade. Now, the other case in which you would treat a trade as a position trade versus a swing trade is if a stock is breaking out of an IPO base. So if you have a recent IPO, say within the last year or two, and it's forming this base, like in this case, Duolingo has just been going sideways for more than a year. And at this level of $113, it's just been finding resistance. On this day, it reported earnings and it had a huge gap up. It broke above the $100 mark and it reported huge subscriber growth or huge revenue. This was a stock that I also traded and might have made a few tweets about as well. In this case, when I see that it's a new stock, not many institutions own it, and it's just come out with really positive news, I want to hold it for a much longer time, and so I treat it as a position trade as opposed to a quick swing trade. Okay, now the third condition for when I would position trade versus swing trade is if we're at the start of a new bull market. So a bear market technically is when the indices go down 20% or more. And once that happens and the market starts to turn, it usually has the potential to roar back and go up 100% or even more. So this is the chart of the NASDAQ in the last 15, 20 years. And let's look at the bear markets. This one lasted a year and the market went down 55%. And as soon as it bounced back, for the next 10 years, the NASDAQ went up 600%. This was another short bear market of 20%, which only lasted 3 months. And when the market snapped back, it went up from this low to this high, 65%. This was the COVID crash that I'm sure you guys all remember. Here, the market went down 30% in a month and a half. And when it snapped back from here, we went up 150% in the NASDAQ in a year and a half. So as you can see, when we snap back from a sharp drawdown of more than 20%, usually there's the potential for the indices to keep going up and make really big gains. And this is a time when, again, you want to focus on position trading and capture those huge moves versus swing trading and letting go of the stocks too quickly. So where are we right now in the indices? We've been in a bear market of more than a year, and we've been down 37% on the NASDAQ, which is a pretty significant bear market. So based on market history, we can anticipate that if we were to start a new bull market, it would be a pretty strong, pretty long-lasting bull market for a year or more. And you would want to hold on to your positions for a much longer time through these. So let me show you a chart of the Qs zoomed into just this current bear market and where we are right now. As you can see, for the last 1 year, we've been in this downtrend of making lower lows and lower highs. And if you draw a simple trend line, it's been going down. What's happened since October is this trend has changed. So we've been making higher lows. So this low, and then this low is higher, and then this low is higher, and then this low is higher, and higher highs. So every high is also higher than the previous one. So this is a classic uptrend. And we've already bounced around 20% off the lows. So there is a very good chance, just purely based on technical analysis, that since we're in an uptrend and have gone up 20% and have broken this downtrend and are above all the moving averages, we might be starting a new bull market. So this is a time when you can think about holding positions for longer if you're anticipating that the bull market does start and we rally for another year or two and the market makes some spectacular gains. So these are the 3 conditions in which I would consider position trading. To recap, one is if a stock makes an EP, like Peloton. 2 is if the stock is a new IPO that's breaking out of a base, like Duolingo that I just showed you. And 3 is if we're starting a new bull market. So in all other conditions, I want to be doing swing trading. And there are also some exceptions to this. So let me go through those now. First thing, this is something you definitely must remember and write it down, is if you're trading a biotech, you only want to be swing trading it. Now, why is this? In the US, biotechs are extremely volatile and extremely unpredictable. They'll frequently gap up and gap down. And look at this example of a random biotech that I picked, which has which frequently gaps down 25-30%. This is not unusual at all. In fact, this is the norm in the world of biotechs. Since you don't want to risk being caught in any of these gap downs, it's best that you hold your biotech stocks for as short a duration as possible, so you're minimizing that risk. So every time I have a biotech stock, I am selling it into strength and taking my profits in 3 to 5 days, which means I'm treating it as a swing trade. And I'll go through the exact sell rules for swing trades, but just remember, if the stock you're buying is a biotech, it's a swing trade, not a position trade. Okay, the second exception is if you need to build portfolio traction, then you're going to swing trade and not position trade no matter what. Now, what do I mean by portfolio traction? It means if my account has been going down, so say this is the usual equity curve, and this is what all of your equity curves should look like if you are a consistently profitable trader. As soon as you start to get drawdowns, or you're just going sideways and your account has no traction, look at these long periods where the account just goes sideways, you're not getting any traction. Say you're down on the month, you're down on the quarter, you're down on the year, your account's not moving anywhere. Those are times when you want to be swing trading and quickly booking those profits and racking up gains as opposed to position trading. So usually your portfolio is not going to get traction if you're in a bear market or a choppy market or a late stage bull market. So for the last 1.5 years, or rather 2 years, since we were first in a late stage bull market, then we went to a choppy market, and then we transitioned to a bear market, my account has pretty much been this way. This is not an actual screenshot of my equity curve, but this is what it pretty much looks like since the time I became profitable. And because right now I'm currently just going sideways and actually even down, and I don't have any traction in my account year to date, I'm actively swing trading, and very rarely will I take a position trade, because first what I want to do is rack up some gains and start to make my equity curve go up. That is our first and foremost job as a trader, which is we want to build that profit, we want to build that cushion for the year, and then we can start to hold positions for longer. So in case you're confused about what portfolio traction is, or how I size my trades, or how to make sure that your drawdowns are just sideways or just single digit low drawdowns, check out the video that I made on position sizing and progressive exposure, because that is the number one thing that's going to determine your success as a trader. That is even more important than sell rules. And what I do in that video is try to take you through an example using hypothetical trades and talking about how your total equity would change and what the changes in the P&L would do to your equity curve. So before you ask me questions on what portfolio traction is and how to go about thinking about it, please check this video out. Okay. Now, the other exception for when you should swing trade and not position trade is if there is news and events. So what do I mean by that? There is a news calendar for all US news events and announcements. It's on MarketWatch, and I can even link it in the description below. But basically, you want to check that. And the big daddy for all of these events is this, the FOMC meeting. FOMC is the Federal Open Market Committee meeting. This is where the Fed announces whether it wants to increase rates or decrease rates. And in an environment like we are in right now, where we have 40-year high inflation and the rates are extremely high, every single FOMC meeting minutes moves the market up or down. So this The catalyst itself might change from time to time. Like during COVID, it was, death numbers from COVID, and that data used to come out and move the markets around. And right now, it's inflation data, like the core CPI, or it's the FOMC minutes, like the current market rates. But regardless of what the catalyst is, you want to be swing trading when there's an impending news and not position trading, because your risk increases greatly. There is no way that you or I, who don't know the Fed chair personally, can know anything that he's going to do. So rather than holding all of our open profits at the mercy of Jay Powell, we go in defense mode and we start to book profits. So I got a great question last Tuesday rather, about right before the FOMC was coming out, about how do you prefer to manage positions around data of Fed events? Like this week, we have CPI, PPI, bank earnings, things like that can move the market. I tend to go flat into those events and just reevaluate after, but curious on your thoughts. So what I simply do is play defense. So I won't have more than 1 or 2 positions that are not already profitable in my account. And I start to take partial profits to build up cushion in my account. And I give the example of Mara, which was a trade that I was in at that point. So in short, I'm reducing exposure and building cushion. And if at a time like this, I'm taking any new trades, it's definitely going to be a swing trade and not a position trade. And that's simply because you don't want to increase your market risk. Okay, so hopefully that makes sense. And let me just go back to show you the chart. Hopefully you have a better idea of what are the criteria for when you would take a trade as a position trade and the criteria for when you would take a trade as a swing trade. Okay. Okay, now I'm going to talk about when to move the stop loss up to break even. And this seems to be a really common question, something that people struggle with a lot. A lot of you have asked me, like DJ Kim, can we also talk about when and why you move your stops to safe? And Jacques asked what rules determine when it's time to move to break even? Or Nay has asked me, maybe I missed it in one of your videos, but when do you move to break even? And Ivan just texted me one of his trades and asked, when do I move my stop to break even? Okay. Surprisingly, the answer is really, really simple. For me, depending on whether the trade is a position trade or a swing trade, the rules are extremely simple. And we just went through what the criteria for determining whether a trade is a position trade or a swing trade are. So if you're still not clear about that, I would recommend first reviewing that. But for all position trades, I move the stop loss to break even after the first natural reaction. And for all swing trades, I move the stop up to break even after 1 hour. It's as simple as that and doesn't need to be made more complicated. Let me show you what I mean by both of these. So an example of a natural reaction would be this trade, SE trade, that I took. I tweeted my entry here and I'm still holding it. So I entered here on the EP day when the company came out with a surprise profitability announcement. And as you can see, it went up a lot on crazy high volume. But since it was a position trade, I was in no rush to make the stock safe. I wait for the stock to pull back, make a new low, and then once it starts going higher, I will move that stop up to break even. So initially, my stop was here, the low of this gap. I let it pull back. It came here, pretty close to my break even. I did not panic. I waited. Once it started going up again and took out this resistance level, Then I moved my stop up to break even here. And then eventually here. I'll talk about that in a bit too. But the basic idea is that when you're in a position trade, you don't want to be too hasty to move the stop up to break even, because that can cause you to get shaken out and often lose your position in the trade. You want to be patient. You want to give the stock some time to come back, have a natural reaction, go back up again, and then move your stop up to break even. And natural reaction is actually a term coined by Minervini, so I just want to give him credit for that. It's not something I came up with. And I find this rule to be really logical when I'm taking a position trade. So I just keep it simple, and this is my only rule for it. Now, if I'm taking a swing trade, on the other hand, since I'm only holding it for 3 to 5 days, I don't want to wait for that natural reaction. The whole idea of a swing trade is that you don't want to hold through those pullbacks or those reactions, but you just want to sell into strength. So the way I would treat a swing trade is as soon as the stock goes up to 1 hour, I make it safe and move the stop up to break even. Now, what is 1 hour? R is simply a risk multiple, and it's the amount that you're risking in that trade. So say I'm risking $100 in that trade, which means if my stop loss is hit, I'm going to lose $100. Now for the stock to go up 1 hour, it would mean that I'm in $100 profit. So if I had risked $100 on the trade and the stock goes up $100, giving me a profit of $100, I'm simply going to move the stop loss up to break even and make that trade free or safe. So an example of this would be Mara. This is a trade that I just took, and so I entered it here. This was my risk, and at the end of the day, this was in the next day in the pre-market. So here, 9:25 a.m. So in the pre-market, it was gapping up. It had gone up more than 1 hour from the entry yesterday. And so I moved the stop loss to break even. And now it's a free trade. And what does it mean for the trade to be free? It means even if my stop loss is hit, I'm going to exit at break even. So I'm going to exit at exactly the same price that I entered it on. And so I'm not going to make money. I'm not going to lose money. It's effectively a free trade. It's going to be $0. So really simple rule that I follow for all of my swing trades. And most of my trades are actually swing trades. I'm primarily a swing trader. As soon as the stock goes up 1 hour, I just move it to break even. And that makes sure that I don't lose any money on the trade. And if you keep your rules as simple as this, you're going to make sure that your drawdowns are as small as possible and your life is as less complicated as possible. And every time you take a trade, you're not asking yourself, okay, when should I make the trade safe? When should I move the stop up? Just create rules for yourself that make sense to you and that simplify your life and your trading. Okay, now the other thing to keep in mind is once you've made your stock safe, how do you trail that stop loss up? And for me, again, that's a very simple answer. For all stocks, whether they are swings or positions, if they pull back and start going up again, I move the stop loss to each swing low. So this is an example of a trade I actually took in Miniso, and I tweeted all of my entries and exits. I took this in November last year. This is where I entered. This was my initial stop. I had taken it as a position trade because this was an IPO-based breakout and had just gone up huge on earnings. As soon as it made a pullback and started going up again, I moved the stop loss from this pink circle to here. Then it pulls back again, basis for a few weeks, starts to go up again, makes a double bottom here. I move the stop loss to here. Pulls back again, starts to go up. I move the stop loss from here to here. Same thing here, same thing here, same thing here. And this way I kept trailing my stop up until I sold everything here. And I'm going to talk about why I sold it here and what the sell rules are as well. But for now, I just wanted to show you how I trail my stop loss. So the reason I do it this way is because it's very logical for me. If a stock is in an uptrend, it should be making higher lows. And all I'm doing is moving the stop up from one higher low to the other. Okay, now I'm going to go through the sell rules for how I sell a position trade and how I sell a swing trade. And just to recap, a position trade is a trade that I want to hold for weeks and preferably months. And a swing trade is something I want to hold for a few days, usually 3 to 5 days. So far, we've already seen that right at the entry, as you're taking a new trade, you want to think about how you're going to sell it. Are you going to position trade it or are you going to swing trade it? These were the criteria for the stocks that you should position trade, and these are the criteria for stocks that you should swing trade. And we also went through when you should move the stop loss to break even for a position trade and when you should move it to break even for a swing trade. So now let's go to the main sell rules that I use for my trades. If I'm in a position trade, then I sell half the stock when it makes the third leg up. I'm going to show you examples of exactly what I mean by that and what the logic behind it is. And I sell the other half either when the stock goes parabolic or when it breaks a trend line. For a swing trade, the rules are super simple. I'm just going to sell half the stock at 2R, which is twice the risk multiple. I already discussed what a risk multiple is when I was talking about the stop loss. So I hope you guys remember that. And I'm going to sell the other half in 3 to 5 days. Let me show you examples of what each of these criteria look like, so you have a good sense of them and also the logic behind them. Now, what do I mean by third leg up? So say this is a stock that is a new EP and it starts its move here. This is where I enter. It goes up for a few days, makes a leg up, pulls back, probably tests the 10 or the 20 MA, makes another leg up, goes up for a few days, pulls back, tests the 10 or 20 MA, and then it makes a third leg up. Now, after 3 legs up, the probability of a fourth leg or a fifth leg greatly decreases. So what I do is just sell half of it on the third leg up. Let me show you an example of this. So this is Miniso, and Miniso was the last position trade that I took. I took this in November when it made a new EP and broke out of an IPO base. And I recently sold it a few weeks ago. And you can check my tweets if you want to know the details of exactly when I entered and why I entered and when I sold it and why I sold it. So Miniso makes a first leg up here. This is super strong. And even though it doesn't look like much, the stock has actually gone from around $8 to about $12, which is a 50% move. It then pulls back, finds support on the 10 MA, keeps going up, makes a second leg up. Then it bases here for a few weeks, just goes sideways along the 10 and the 20. And then it breaks out and makes a huge third leg up. Now, this is when I would start thinking about selling. Since this is a third leg up, for it to make a fourth leg or a fifth leg, it's definitely possible. And currently the stock also looks like it might want to keep going up, but the probability of that is really, really low. And what I typically do is I would sell half of it here when the third leg is looking quite extended to me. And then if it breaks out again and tries to make a fourth leg, I'm happy to take it, but I take it as a swing trade because it's already a very old trend. So that would be the first case where I sell. So that would be where I sell half of the position trade. Now the other half, I'm either selling when the stock goes parabolic or when it breaks the trend line. So let me show you what a parabolic move looks like. The definition of a parabolic move is super simple. All it means that the angle of the trade has changed, the angle of the stock. So if you look at this, SPCE, this is the angle at which it's been going steadily. The same angle was maintained here. All of a sudden, in these 4 days, the angle changes. It becomes a lot steeper. So when I see that angle changing and a stock just going wild and parabolic, like here SPCE went from around $25 to $40 in like 3 days, or rather even 2 days, that's not normal. And that's when I would sell the rest of the half the position. So I would get out completely from the stock. And when a stock goes parabolic, that's usually a very good sign of it topping. Now, this can also be seen in the indices sometimes. So this is an example of the NASDAQ, the QQQ. And sometime in 2020, I remember it suddenly started to accelerate. And you can see the rate of change increased. It started to go a bit parabolic. And this is when I started to take off a lot of exposure around these days and put on less and less exposure because this kind of move is not sustainable. And a stock is usually going to break and come down, take a few days of a breather or a pullback after it starts to go parabolic. So if either of these two scenarios occur, that is either the stock is going parabolic or the indices start to go parabolic, you can start to remove some of your exposure or even sell out completely and just book profits, which is what I like to do. Because once it's gone up parabolically, it usually falls super fast and you may not even get a chance to get out at the price where you initially were. So even in this case, you can see it just starts to get wild and then just gaps down one day. So if you don't want to be in for these kinds of surprises, then you better sell into the strength and just get out while it's going parabolic. Same thing here. The next morning, it just opens and just starts selling off. So you either sell into strength or be really quick and take a chance. I prefer the former. Okay, the last reason that makes me get out of a trade completely is if a stock breaks a trend line. Now, this is the same Miniso trade that I was. The other reason why I might get out of a position trade completely is if it breaks a trend line. So a lot of people might have heard of the rule that if it closes below a moving average, you want to sell the stock. And that's what I used to do previously too. But I found that it used to shake me out a lot of times. And a better, more logical way that I have found to do it is to draw a trend line instead. And once it breaks the trend line, to sell it at that point. So this is the same Miniso trade that we were discussing. And the second the last part of my position, I actually sold on this day and tweeted about it as well. And the reason was because it had been going up at this angle, and you can draw a trend line when it touches 3 price points at a minimum. That's when it becomes valid. Because otherwise, if your criteria is only 2 points, you can connect any 2 points and draw a trend line here or here or here, and it's not very meaningful. But once it's connecting 3 lows, That's a very meaningful trend line. And so on this day, when it broke that trend line and closed below it, that's when I actually got out of my entire position in Miniso. Oh yeah, and I have a screenshot of the tweet here to show you that this is exactly the kind of simple logic that I use when I'm actually executing my trades. So the day before, I had tweeted, so on March 20th, on this day, I had tweeted, we now have a clear trend line that the stock is respecting, still riding my position from November, moving stop up to yesterday's low, that is here, as break of the trend line could lead to a fast move to the downside. And then on March 21st, all out on break of this channel, and in total, from my entry on this day, the stock had moved up 80%. So I hope the logic is clear behind this and this makes sense. Okay, now for a swing trade. For a swing trade, the sell rules are super simple. I just sell half at 2R and then half in 3 to 5 days. So this was the most recent trade that I closed. This was 2 days ago. I had entered Mara on this day when it broke this trend line. Next day, it had gone up 2R. That's when I booked half. And then on the 5th day, I sold the remaining position. In total, it went up 40% from my entry point, and I closed the trade in 5 days. This is a classic example of a swing trade that I would take, and the super simple sell rules that I use for all of them. The logic behind taking the partial off at 2R is that it finances my risk. So since I would have risked, say I would have risked $100 on the trade. If the stock has gone up 2R, that means I'm sitting on an open profit of $200. If I'm selling half of the position there, that means I'm booking a profit of $100. So I had risked $100 and now I've made $100 in my account. I can now use that $100 profit that I made in my account to finance a new trade. That is the logic behind selling a partial at 2R, putting some money into your account, recycling it, putting it into a new trade, and giving yourself a chance to make even more money. And the reason I sell the other half at 3 to 5 days up is because most swings, most stocks just go up in short swings of 3 to 5 days. So even take a look at Mara here. This little swing was 4 days. This little swing was around 5 or 6 days. This little swing was 3 days. This little swing was 4 days. That is just the nature of stocks. And credit to Pradeep Bonde because this is something I learned from him and then confirmed with my own study. All I'm doing is taking a structural tendency of stocks, which is to go up for 3 to 5 days, and making my sell rules around it. That is the simple logic behind this rule. Okay. This is another example of a trade that I just took and I just tweeted about today, just to give you another idea. Yesterday, I went long IoT, and as soon as it moved, since it was a swing trade, and I noted that here, as soon as it went up 1 hour, I moved it to break even. It had gone up 1 hour the same day itself. And then today, when it went up 2 hour, I just booked profits on half. And now I still have the other half open. And since it's already gone up 3 days, I'll likely sell it tomorrow or the day after. Okay, now I want to talk about when to take a loss. And sadly, I have no questions about this. Literally, no one seems to want to know when to book a loss, even though this is way more important than when to book a profit. Because if you let your losses get too big, that is the end of your trading career and that is the end of your account. So the rules for this are super simple. Let me take you through them. So two situations that would possibly cause you to take a loss on a trade. One is when your original stop loss is hit. Now, if that happens, you get out, no questions asked. There is no ifs, no buts, no bargaining, no exceptions. Your stop loss is hit and you get out. That's it. This simple rule itself will save you from doing great damage to your account. Don't hope, don't pray, the stock will come back. Oh, it's just a minor dip. Oh, it's going to come back tomorrow. No, we've all done that. We've been there. It doesn't work that way. And it's just going to delay your progress. So remember this rule. This is a golden rule of trading. No matter what system you trade, whether you're a day trader, swing trader, position trader, if your predetermined stop loss is hit, get out. Okay. Now there are three situations in which I would get out even before the stop loss is hit, which means even before the stop hits -1 hour. So the first is if there's not enough cushion at the end of the day. What does that mean? Now let's say I entered a stock at 100 and my stop loss was at 95. At the end of the day, the stock closes at 96. That means it's super close to my stop loss. And if we have a gap down in the stock tomorrow, then the stock might open at 94, 93, or even 90. I don't have enough cushion at the end of the day to hold that stock overnight and risk a gap down. So what I'm going to do is exit it at the end of the day, and that would be a -0.8 hour loss in this case. And that would be fine because my goal is never to have a loss bigger than -1 hour. Now, the second scenario is if I don't have enough cushion in the stock and its earnings reports are coming out. So the same logic as this here. If the stock is very close to the stop loss and I don't have enough cushion and a huge event like the earnings or some other news catalyst is about to come out in that stock in the after hours, then you want to get out because you don't want to risk a big gap down. Same reason, same logic. The third condition is something that I learned from Minavini, and he calls it the train not arriving on schedule. And what that essentially means is maybe you bought a stock and you expect it to break out and just keep going up for 3 to 5 days, right? Say the stock doesn't do that and just keeps going sideways. And it's drifting, drifting, drifting. The rest of the market is breaking out, but this stock is not doing anything. And maybe the volume is not that good either. It's drifting on pretty high volume, which is not something you want to see if a stock is consolidating. So what you can just do, scratch it off, sell it at whatever price it is. Maybe it's near your break even. Maybe it's halfway to your stop loss. Whatever the current price is, take that risk off and maybe put your money to work in something much better. So if you're expecting the train to arrive at a certain schedule, that means in other words, you're expecting the stock to break out and it doesn't do that for a really long time, then you just give up on it, take a loss and move on. So those are the simple rules for when you should take a loss. And this is the most important one that you never, ever, ever want to take any exceptions on. Hopefully the logic and the reasons behind all of these make sense. No matter what your stop loss rules are, you need to have some into place so that you never damage your account and don't end your career prematurely. Okay, So now that brings me to the end of the cell rules video. Let's just do a quick pop quiz so you can test your own understanding of everything that we spoke about here. This is a message I got from Subodh Sharma earlier today. Let's see if you can answer these and ask yourself if you're now in a better position to Okay, so this brings us to the end of the cell rules, and let's end with the pop quiz to test your own understanding. Also, congratulations if you made it this far, because that means you're seriously dedicated to learning about trading, and you're probably going to make it as a trader. So I got this message earlier today from Subodh Sharma, and let's see if we can answer this together using what we just learned. So question 1. In the current semi-bear transition phase, should we hold until close below 10 DMA or such, or just keep a 3% type trailing stop loss? Okay, so based on what we just learned, we know that in a semi-bear or transition phase, which is what we're in now, his portfolio is not likely to get much traction, just like mine and most other swing traders. So very simply, we would not hold for a moving average breakdown. We would just sell into strength, sell half at 2 hour, sell the rest at 3 to 5 days. And I don't use trailing stops as such with the percentage amount, but that is something you can look into and you can do if that makes more sense to you. What I simply do is use R multiples. So when the stock goes up 1 hour, I would move it to break even, make it safe, sell some at 2 hour, and then sell the rest at 3 to 5 days. Hopefully that's what you were thinking too when you saw this question. And if not, you might want to go back and review the video again. Okay, second question. Should we just go for 5 to 8% and same day exit or take off our trade from volatility? So, interesting question. If, first of all, you're assuming that the stock is going to go up 5 to 8% the same day, and this also doesn't tell me what your stop loss is, so I can't tell you how many R multiples that is. I would not take off trades the same day because I have found day trading to be extremely difficult and way more unpredictable than swing trading. So again, my advice to him would just be hold the stock. If you have a cushion overnight, move it to break even as soon as you have as much profit as the amount you had risked, meaning it's gone up 1 hour, and then start peeling at 2 hour and 3 to 5 days. Hopefully, this is what you were thinking too. And if anything didn't make sense in the video, or there's anything that you disagree with, like the logic behind what I said, do let me know in the comments because I'm always open to constructive criticism. That being said, there are many different ways to trade, and your cell rules might be different than mine. As long as they make sense mathematically, that's great. But if something that I said doesn't make sense mathematically, definitely let me know. And if you benefited from learning from this, or this just gave you some food for thought or ideas about how to think of your own cell rules, then I'm super glad because that was the point of this whole video. So thank you and see you soon.